Hi everyone, welcome to ACCA F6 UK lectures. In the previous lecture, we looked at the taxation and taxation in the UK in particular. As I said in the previous lecture, we will look into the income tax pro forma in the next video. Now here you go, income tax pro forma is already given to you on the board. I've just made it up, and please make sure you note it down. This pro forma is already given to you in the on the lecture notes anyway, but whatever I am writing down on the board, please make sure you write it down. The reason I've listed down on the board is because I will explain the things which are part of the income tax pro forma in details while writing down here on the board. You will understand it in a better way, and it will be helpful while revising for the exams. Alright, so please make sure whenever I move across the when I'm not in front of the board, please make sure you pause the video and just note it down, whatever I've written on the board. Alright, and apart from that, if you're watching these lectures on YouTube, please make sure you watch the lectures on our own website, AccountancyTube.com. The reason you should watch on our own website is because that's where you will find the lectures in right order. Say for example, if you're watching on YouTube, the first lecture, if you're watching this lecture, next lecture might be lecture number 10, so you never know. They are not in the right order on YouTube, and the students face a lot of difficulties if they are watching on the YouTube. They might miss any lectures, or they might, they're not in the right order basically. We have received, in the previous session, we have received lots of emails asking us that some of the lectures are missing, and it took a lot of time to respond to each of the emails. So please make sure you watch the lectures on our own website, but you should also subscribe to our YouTube channel, because that's where our videos are uploaded, and you will know that this video is now available on our website. Alright, anyway, so that is our income tax pro forma. Now before we move to income tax pro forma, as I said to you in the previous lecture as well, we have explained the taxation. Now this income tax pro forma, this lecture and all of the following lectures are of the Finance Act 17. So our tax year starts from the 6th of April to 5th of April. HMRC says that tax year will start from the 6th of April, it will end on the 5th of April. Accounting year is a little different, if you know. Accounting year starts on our own will. Say for example, if I've started the business on 1st of January, I can start the accounting year that day, and it will end on the 31st of December. So it is really up to me. However, the tax year is not up to us. HMRC has given us the date. It starts on the 6th of April, it ends on the 5th of April. For our current tax year 17, Finance Act 17, our tax year starts on the 6th of April 2017 and it ends the 5th of April 2018. So that is our time span. Alright, so I've given the name on the top, income tax pro forma. So name of the taxpayer is Alex. Then income tax computation, that's what we are doing. And for which tax year are we doing? For the tax year 17-18, as I've listed down on the board as well. Alright, so we are making the income tax pro forma. Who makes the income tax pro forma? Every individual in the UK. Every individual in the UK who is earning some money, they will have to make the income tax pro forma. While living in the UK, I could earn the income from many different sources. I will have job, I will have business, I will have property, I will have interest income from the money which I have invested in the bank. I might have some shares in the company, and I might be getting some dividends as well. So there are different varied range of sources of income from which I can earn the income. I have to list down all the sources of income in income tax pro forma on which I have to pay the income tax. I will list down all the income sources, and then I will accumulate them, total them, and then we will see that how much tax we will have to pay according to the tax rates. Alright, so that's what we are doing. Name of the taxpayer, income tax computation. Name of the tax year, I've made it up, Alex. Then income tax computation for the tax year 17-18. HMRC says that doesn't matter how many sources of income have you got, but please make sure you classify them into 3 different categories: non-savings, savings, and dividend. That's what HMRC says while making the income tax pro forma. So that's what we did. We have classified the income into 3 sections: non-savings, savings, and dividend. Now common sources of income I've listed down on very left side in the description side. These are the common sources of income in the UK which you can find in the questions, and normally we will have the income from these sources. Now the question is, which source of income will go into which section? Trading income, pension income, property income, employment, interest, dividend. Alright, hang on, dividend. Now there is a list of dividend here section, so I think the dividend will go into the dividend. What do you think? Yeah, I think you're right. Dividend will go into the dividend. So go ahead and put it in the dividends. So whatever the dividend amount is given in the question, take the dividend amount, write it down, dividend income, and put it here as dividend. Whatever the amount is, it will go under the dividend section. All right. And another important thing is that this order is not important. Even if you want to write down the dividend income first, it's up to you. You won't be deducted. You won't deduct. The examiner won't deduct any marks from your marks. All right. So dividend income will go into the dividend. Now the savings income, there is a section of savings income as well. Now say if I have some savings out of the salary, I put some amount as savings. Now instead of putting that amount at home, I think that I should put it in the bank. When I put it in the bank, they will pay me some interest as well. So if I put £100, after 1 year, it could be £103, £107, you never know. So, but it will be more than what I would have had at home. And if I keep at home, I might spend as well. So I will put it in the savings account in my bank, and then bank will pay me some interest. So that interest is coming out of the savings. So interest income is given here. Interest income will go into the savings income because interest is coming out of the savings. So interest will go into the savings income. So whatever the amount of interest is given to you, you will have to put the same amount in the savings section, just like the dividends. No need to gross up. Whatever the amount is given, we'll put the same amount into the savings section, and same amount in the dividend section. Now these are the only two sources of income which will go into the different columns. The rest of the stuff which is given here will go into the non-savings income. That's so easy. So only dividend will go into the dividend, interest income will go into the savings income. The rest of the stuff will go into the non-savings income. So whatever the source of income is, pension income, non-savings, trading income, non-savings, property, employment, everything. So all of these will go into the non-savings. Trading, pension, property, employment, and whatnot. Interest income will go into the savings, dividend income into the dividend. What is trading income, by the way? Trading income is when I am trading, when I am doing the business. So that income is a non-saving. What is pension income? There is a separate chapter on pension. There is a separate chapter on trading income as well. There is a separate chapter on property income and employment income. So we will see all of them in details in the coming chapters. Pension income basically is whenever you are working for someone, the employer might take something out of your salary and put it as your pension. So whenever you retire, instead of relying on government resources, you just rely on your own money. The employer can do so, you yourself can do so as well. Now out of the salary, you might pick some amount and go to bank and say, I want to make my own pension. The bank will say, all right, you will have to contribute £50 every month. So you will have to contribute £50 to your bank. So whenever you retire after 20 years, 50 years, whatever, then that amount, you will have a big chunk of amount on which you can rely your retirement period, post-retirement period. All right. So instead of relying on the government benefits. All right. So that's what pension income is. Property income is simply when you have the property and you want to let it to someone. You have extra room, you want to let it to someone. You are earning some money. That is property income. Employment income is simple. Whenever you are doing a job, you are being paid some salary. That is employment income. Interest income, as I've already explained, go into the savings income. Dividend income will go into the dividend income. That's it. These are the sources of income. After that, we will deduct the deductible interest. Alright, so right then, so that's it. After doing that, we will have to deduct the deductible interest. Now deductible interest will be deducted first from the non-savings income, and if there is something left, then we will deduct it out of the savings income, and if there is still something left in the deductible interest, then we will deduct it out of the dividend income. Alright, so our first preference would be we will deduct from non-savings. Second preference is savings income. The last preference is to deduct from the dividend income. So shall I write it down as first preference? That is my second preference, and it is my third preference to deduct the deductible interest. What is deductible interest? We will see later when we move to our notes. But deductible interest, just take it as deduction for now. Now this amount is net income before personal allowance, after deduction of the deductible interest. That is our net income before personal allowance. And after that we have to deduct the personal allowance. Now what is personal allowance? I will tell you in a minute, but just take it as deduction for now. This is a deduction. Alright? After the personal allowance, that is our taxable income. That is taxable income on which we have to pay the tax. Because of the less space beneath that, I've written down the rest of the stuff here. You can continue writing down beneath that. Alright? So calculation of tax liability. So whatever the taxable amount is, this one here, we'll have to apply the tax rate which are given to us in the exam paper, and these are given to us in the lecture notes as well. I will tell you that how to calculate the tax, but for now assume it is 20%, 40% or whatever. So we'll apply the percentage as per the bands which are given to us in the question, which are given to us in the exam paper. Then we will deduct the less tax deducted at source. Alright? Now tax deducted at source is a tax which was deducted when the money was paid to you. Now when you are working for someone and you are being paid some salary, some amount is took out of your salary as taxation. That amount is pay as you earn, P-A-Y-E, pay as you earn. So we will deduct that amount. Now here we will always write down everything gross. Even if you're taking anything net, we will have to gross it up and we'll have to write down net gross amount here. Luckily there isn't anything in your syllabus which will be given to you net amount. All the things will be given to you gross amount, so no grossing up needed. Everything, whatever the question amount is given in the question, just pick it up and put it in the income tax proforma. As easy as that. Alright? So pay, tax deducted at source is pay as you earn. The amount which was deducted from your salary, it will be given to you in the question, and deduct that amount. And after deduction of that amount, income tax payable, if it is a positive amount, if it is a negative amount, income tax receivable. You have to receive something because you have paid extra tax, you have to receive from native revenue and customs. So that was our income tax pro forma. Couple of things before I wind up this lecture. One is the deductible interest and other one is personal allowance. Now both of these will first be deducted from the non-savings income, then from savings income, and if there is still anything left, we will deduct it out of the dividend income. Sometimes what happens is that non-savings income is just £100 for example, whereas the deductible interest is more than £100. So we will deduct that to make the non-savings income zero. Then the remaining deductible interest, we will deduct it out of the non-savings income, and if there is still anything left in the deductible interest, then from dividend income. Likewise for personal allowance as well. But the question arises, what is deductible interest? Now whenever I go to bank and I ask my bank that please give me some loan, they will ask me definitely what you want the loan for. What is the reason for your loan? I will say I want to use that loan to invest in my business. Then they give me the money, then I invest in the business. Now when they give me the loan, of course they are not giving me for free, they are charging me some interest. Now that interest is deductible interest. That interest will go here and we will deduct, it will reduce our income tax liability. Alright, so that is good thing. So whenever I take a loan, I pay some interest on that loan, that interest will be deducted. But there are certain reasons for which you can take the loan and to be deductible interest. This list is given to us in the notes, we will see later. But for now, deductible interest is the interest which is paid when I take some loan and invest in one of the conditional reasons which are given to us in the notes. We will see later in the notes. Alright, so that was deductible interest. Next thing is to understand what the personal allowance is. In the UK, up to 11,500, you don't have to pay any tax. So every individual in the UK, if you are living in the UK, you are allowed to earn up to £11,500 before you pay any tax. So up to 11,500, you don't have to pay any tax. Alright? So that is a personal allowance, a personal exemption. So everybody in the UK is eligible to have the personal allowance of 11,500. Now, amount which you're earning in excess of 11,500, you have to pay tax on that depending on how much you are earning. Alright, so that's why 11,500 will be deducted out of the non-savings income first, then from the savings income, and finally from the dividends income. Which will give us the taxable income and on which we'll have to pay the tax. Alright, so that was our income tax pro forma. Just a quick revision. What is the difference between accounting year and tax year? Pause the video and tell me. Yeah, you're right. Accounting year is up to us. Whenever I start my business, I can make up my account to whatever date I want. Where the tax year, it is not up to us. HMRC tells us from 6th of April to 5th of April. Our Finance Act is Finance Act 17. So our tax year starts from 6th of April 2017 and it ends on 5th of April 2018. Yeah, you're right. Alright, so we are making the income tax pro forma. Every individual in the UK who is earning some money will have to pay income tax pro forma. Who is making this pro forma? Individual can make, but normally accountants, us accountants are responsible to make the income tax pro forma. A client might pop into your office and ask, I have these sources of income, could you please tell me how much tax I have to pay? You'll have to make up this pro forma, right? So make up the pro forma, write down the name of the taxpayer on top, Alex, income tax computation for the tax year, whatever the tax year is. Then divide the income into three sections: non-savings, savings, and dividend. Dividend income will always go into the dividend section. Interest income will go into the savings income. Rest of the stuff will go into the non-savings income. We'll have to deduct the deductible interest out of the non-savings income first, then from savings, and finally from dividends. So is personal allowance. First from non-savings, then from savings, and finally from dividend. How much is the personal allowance anyway for our current tax year? 11,500. Years ago, I remember it was £6,000, but now it's almost double, 11,500. You never know, it will be £20,000 soon. Alright, okay, anyway, for our current tax year, it's 11,500. So we'll deduct the personal allowance from non-savings income first, then from savings, and finally from dividend. What is personal allowance? Every individual in the UK is eligible to earn up to 11,500 before they pay any tax. So in excess of 11,500, whatever they are earning, they might have to pay any tax, but up to 11,500, they don't have to pay any tax. What is deductible interest? If I take some loan and invest in one of the conditional reasons are mentioned in our notes. If I take the loan and invest in one of the conditional reasons, then interest which I'm paying on that loan is deductible interest. Depending on what was my reason, we will see in the notes. That interest is deductible interest. Likewise, personal allowance after deduction of both taxable income. Now, how to calculate the tax? There are different bands. Up to 11,500, you don't have to pay any tax. On top of that, up until, I don't know, £30,000, you have to pay a tax at the rate of 20%. Then from 30,000 to 100,000, there will be a different rate, likewise. So assuming the tax rate is 20%, so whatever the taxable amount is, multiplied by 20%, that is tax liability. But we will have to reduce that tax liability by deducting tax deducted at source. Tax deducted at source is a tax which was deducted when the money was paid to you, like salary, for example. When the employer pays you the salary, HMRC says to your employer, deduct the tax first, then pay the net amount to your employee. Alright, so that pay as you earn, it will be deducted, and the net amount after the payee, whatever the amount is, if it is a positive amount, it will be income tax payable to HMRC. If it is a negative amount, income tax receivable from HM Revenue and Customs. That was it. That was income tax pro forma. In the following video, in the next video, we will look at one of these things, like for example, personal allowance, the deductible interest. We will continue looking at one of these items. There's a separate chapter on most of this stuff, so don't worry. We will see how to calculate trading income, how to calculate pension, how to calculate employment, how to calculate property income. So you don't have to worry. Just keep following our lectures and download our lecture notes. At the end of the lecture notes and the lectures, do the practice from practice and revision kit, and off you go to your exam. Good luck for you, and I will see you in the next video, and we will continue with income tax. Good luck. Bye.